What would you pay for access to the most powerful computing infrastructure on Earth? Apparently, Google's answer is $920 million per month. SpaceX quietly amended its IPO filing this week, burying inside an updated S-1 a deal that sent financial analysts scrambling. Google has agreed to rent SpaceX's AI computing capacity for nearly $1 billion every single month from October 2026 through June 2029. At the same time, Alphabet's own CEO just announced the company raised $85 billion in the most oversubscribed equity offering in recent memory, with Warren Buffett's Berkshire Hathaway writing a $10 billion check. The AI infrastructure arms race has just gone to a level that would have seemed like science fiction 2 years ago. And in the middle of all of it sits Elon Musk, about to take SpaceX public, sitting down with JPMorgan's Jamie Dimon to explain why now is the moment. This is a story about money, power, and who is building the backbone of artificial intelligence. In this video, we are going to break down the SpaceX S-1 amendment and what the Google AI deal actually means for both companies and for investors. We will explain why the S&P 500 is blocking SpaceX from fast-tracking into the index and the rule at the center of that fight. We will look at Alphabet's $85 billion equity raise and what it tells us about where the smart money thinks AI infrastructure is heading. We will connect all of this to the broader battle for AI dominance, and we will end with the question every investor should be asking right now: is the SpaceX IPO the deal of the decade or the most dangerous hype in a generation? Let us start at the beginning and work through what we actually know. The story broke on June 5, 2026, when a tweet from the @Elon Musk account announced that SpaceX had quietly amended its S-1 filing, revealing a landmark commercial agreement. Google would pay $920 million per month for AI computing capacity from SpaceX, starting October 2026 and running through June 2029. The Post noted that either party can terminate the agreement with 90 days notice, a clause that adds significant risk to what would otherwise be a roughly $29 billion total contract value over the full term. Yahoo Finance confirmed the news independently, with a headline reading simply, SpaceX to rent AI capacity to Google for $920 million per month. This is not a trivial figure. $920 million per month is $11 billion per year, more than the annual revenue of most Fortune 500 companies. It is also a commercial bet by Google that SpaceX's Starlink satellite infrastructure and computing network can serve as critical backbone for AI workloads at global scale. The content index funds managing trillions of dollars, and its absence creates a genuine overhang for the IPO's institutional demand picture. Now let us zoom out and understand why these three events, the SpaceX Google AI deal, the Alphabet equity raise, and the S&P 500 exclusion, are actually one interconnected story about the future of AI infrastructure financing. The first question many viewers are asking is, why would Google agree to pay SpaceX nearly $1 billion a month for computing capacity when Google already runs one of the largest AI infrastructure networks on the planet? The short answer is that the AI compute demand crisis is so severe that even the largest technology companies cannot build fast enough to meet internal needs. Google's agreement with SpaceX for Starlink-based AI capacity may suggest that satellite-delivered computing, the ability to serve AI workloads from orbital infrastructure globally, is now being treated as a genuine enterprise-grade solution, not a novelty. This is architecturally significant. The 90-day termination clause also tells us something. Both parties are hedging against an extremely fast-moving technology landscape where the compute paradigm may shift again before 2029. A second pressing question is, what does the Alphabet $85 billion raise mean for the rest of the market? On that front, Berkshire Hathaway's $10 billion investment is the signal that commands the most attention. Warren Buffett's firm has historically been deeply skeptical of technology sector valuations and has avoided capital-intensive tech infrastructure bets for most of its modern history. A $10 billion commitment to Alphabet's AI infrastructure program is a statement that even the most conservative major institutional investor on Earth now believes AI infrastructure is a durable, generational investment category rather than a speculative bubble. This may reshape how pension funds, sovereign wealth funds, and family offices approach technology allocation, which directly connects to the broader context of the SpaceX IPO. Some analysts believe the S&P 500 exclusion battle is the most important near-term overhang. Trillions of dollars in passive index funds are mandated to own whatever is in the S&P 500. If SpaceX is excluded at launch because it is unprofitable, the same standard that historically kept Amazon out for years, the IPO may be priced at a significant discount to where it would otherwise trade with full index inclusion. Why would Google pay SpaceX nearly $1 billion a month for computing when Google already has its own infrastructure? The AI compute demand crisis may be so severe that even Google cannot build data center capacity fast enough internally. SpaceX's Starlink-based satellite computing may suggest orbital AI infrastructure is being treated as an enterprise-grade solution for global-scale AI workloads. The 90-day termination clause suggests both parties are hedging against a rapidly evolving compute paradigm. What does Berkshire Hathaway investing $10 billion in Alphabet's AI race tell us? Berkshire's historic skepticism of capital-intensive tech bets makes this a generational signal. Some analysts believe this may indicate that even the most conservative institutional investors now view AI infrastructure as a durable investment category rather than a speculative cycle, potentially reshaping how pension funds, sovereign wealth funds, and family offices approach technology allocation globally. In the United States, the SpaceX IPO and Alphabet raise are reshaping how everyday investors, retirement accounts, and pension funds think about technology exposure. For retail investors specifically, the S&P 500 exclusion debate matters enormously because if SpaceX eventually gets added to the index, the forced buying from passive funds could create significant price appreciation for anyone who owns shares at IPO. The jobs dimension is also real. SpaceX's Starlink and AI computing expansion represents one of the fastest-growing high-skilled employment sectors in American aerospace history. In Europe, the SpaceX Google AI deal and Alphabet's capital raise land during a period of acute concern about technological dependency on American platforms. European regulators have been watching US AI infrastructure consolidation with growing anxiety, and a near $1 trillion AI financing event concentrated in two American companies, Alphabet and SpaceX, will intensify calls for European sovereign AI investment and data localization rules. In Asia and emerging markets, the implications of satellite-delivered AI computing are potentially transformative. For regions without the dense fiber and data center infrastructure of the US and Europe, Starlink-based AI computing access could represent genuine democratization of AI capabilities, or it could represent a new form of technological dependency on American corporate infrastructure. In China, according to its CFR_org research, China's export machine has been accelerating even as its import growth has been unimpressive, a structural imbalance that makes Western AI infrastructure investment ever more strategically significant as a hedge against potential decoupling. A Deutsche Bank research analyst quoted by its CFR_org warned more broadly that the current geopolitical moment is eroding long-standing financial architecture, a context in which AI infrastructure ownership is becoming as strategically important as oil reserves once were. Now, to be intellectually honest, the strongest skeptical case against the SpaceX IPO story deserves a full hearing. The bull case for SpaceX is obvious: a near $1 billion monthly Google contract, a charismatic founder, revolutionary technology, and the greatest capital formation moment in AI history. But the bear case is serious. SpaceX remains unprofitable, which is why the S&P 500 is blocking its fast-track index inclusion. According to Ars Technica, the exchange flatly refused to waive the profitability rule for unprofitable AI firms. This matters because a company burning cash on the scale required to build orbital AI infrastructure while simultaneously funding Mars missions is a fundamentally different risk profile than, say, a software business with 90% margins. The 90-day termination clause in the Google deal is not a footnote, it is a signal that Google could walk away from nearly $1 billion a month in payments with 3 months' notice if a cheaper or better solution emerges. In a technology landscape that is moving as fast as AI compute, that is a non-trivial risk. There is also the question raised by its CFR_organ Deutsche Bank analysts about petrodollar erosion and the broader fragility of the US financial architecture in the current geopolitical environment. Some analysts believe that if the Strait of Hormuz conflict reshapes global energy pricing away from dollars with the potential petro-yuan scenario, the macroeconomic environment that has allowed US tech valuations to reach these levels could be structurally undermined in ways that make even the most exciting IPO a difficult investment at the wrong price. Here is the question nobody is asking loudly enough. If Google is paying SpaceX $920 million every month for AI computing capacity with a 90-day exit clause, what does Google know about the future of orbital AI infrastructure that the rest of us don't? And more importantly, is that clause there because Google is confident, or because it is not? Drop your take in the comments. Are you buying the SpaceX IPO at launch, waiting for a dip, or sitting this one out entirely? If you want more breakdowns like this every time a mega deal drops, subscribe and hit the notification bell right now. We cover every major market moving event with the analysis you won't find in a headline.